Welcome back to the last lecture of the course. So on this part, we're going to discuss both the tangible and intangible long-term assets. So the first topic that we're going to discuss is four different methods of depreciation for long-term tangible assets. And hopefully you can recall from intro financial accounting that we discussed or learned straight line method and at least double declining method. Okay, so we're going to spend some time calculating the amount of depreciation that you want to record at the end of each year for four different types of methods. Okay, so let's start out with the straight line method. Okay. All right, so at the beginning of year one, this company purchased a machine for $250,000 and made the following estimates at that time. So estimated residual value, $40,000. So when we say residual value, that is basically the value that the estimated value of the long-term asset at the end of service life. Okay, so it says service life 5 years. What this means is that this company is planning to use this asset for 5 years. Okay, so after using it for 5 years, the company thinks that the value of the asset will decrease to $40,000. Okay, all right. So first method, okay, number one, it's called straight line method. Okay, so the formula for straight line method is as follows. In numerator, we're going to first use the purchase price of the long-term asset price, and then we're going to subtract it by the residual value. Okay. And then in denominator, we are going to use service life, the number of years or number of periods the company is planning on using the asset for. Okay, so in this case, purchase price $250,000, and then residual value after using it for 5 years, $40,000, and then we're going to divide it by 5 years of service life. Okay, that means every year, we're going to depreciate the asset for 250,000 minus 40,000 and then divided by 5 years. So every year, we're going to depreciate the asset for $42,000 per year. Okay. All right. So what does that mean? Okay. In the balance sheet, at the end of year one, okay, there you go. There you go. We have this long-term asset, the purchase price, $250,000. Okay. And then below that line, you will see accumulated depreciation account. So at the end of year one, we depreciated by $42,000. So the net value or the book value of the asset is going to be $208,000. Okay. And then at the end of year two, okay, so in the balance sheet at the end of year two, okay, we still report this asset at purchase price of $250,000. And year two, we add an additional $42,000 of depreciation. So accumulated depreciation at the end of year two becomes $84,000. Okay, so that means the book value or the carrying value of the asset becomes $250,000 minus 84,000. So it becomes $166,000. Okay. So that's what we mean by depreciation of long-term assets. We continue to lower the value of long-term tangible assets in this case because they lose value as time passes. Okay. All right. So that's what it means to have report depreciation. Let's record the depreciation journal entry at the end of each year. So the journal entry is debit depreciation, okay, depreciation expense. Okay, we calculated at $42,000. Okay, so $42,000, and then credit accumulated depreciation. Okay, $42,000. So this is a depreciation expense journal entry that you record at the end of each year for the next 5-year period. Okay. All right. So as you can see here, straight line method is somewhat straightforward. We just apply the formula to calculate the amount of depreciation that you record at the end of each year. Okay. All right. Let's move on to double declining method. Okay. There you go. Double declining method. Number two, double declining method. All right. Double declining method. Let me first provide you with the formula. Okay. So the formula is you take the book value of the asset, and then since it is double, we're going to multiply it by 2 in numerator, and then divide it by service life. Service life. Okay, so this is the formula for double declining depreciation method. Okay, so for that, let's apply the numbers here. All right, now for this one, I'm going to actually write down all of the depreciation schedule until the end of the service life, 5 years. Okay, all right, so year one, maybe I can do this. Year one, let us first calculate the amount of depreciation. Okay, so the book value in year one is basically the purchase price. It's the first year that you purchased the asset. So the purchase price or the book value, $250,000. We are going to multiply this by 2. Let me give myself a little space here. Multiply by 2, and then over service life. We're going to use it for 5 years. Okay. So if I do the math calculation here, $250,000 times 2 divided by 5. Okay. That means the amount of depreciation expense that you want to record in year one is $100,000. Okay. So what does that mean? Okay. It means the book value, okay, the book value or the carrying value of the asset decreases by $100,000. So initially it was $250,000. We're gonna decrease it by $100,000. So at the end of year one, the book value of the asset will decrease to $150,000. Okay. All right. Year two. Year two, the book value, okay, as of last year was decreased to $150,000. So that's our starting point. $150,000. We're going to multiply by 2 over service life. Service life. Okay, so $150,000 times 2 divided by 5. Okay, so the amount of depreciation expense that you want to record in year two is $60,000. As you can see, the magnitude, the degree to which that the company depreciate this asset is decreased. Okay, so previously it was $100,000, now $60,000. So what that means is that at the end of year two, the book value of this asset, okay, becomes 150,000 as of last year minus additional $60,000 of depreciation expense. So the book value becomes $90,000. All right, now let me just do one more year. Okay, what year three? Okay. All right, year three, we started out the year with 90 $30,000 of book value of the asset multiplied by 2 over service life, 5 years. Okay. All right. So $90,000 times 2 divided by 5. Okay. So the amount of depreciation for year 3 becomes $36,000. Okay. So we are going to decrease the value, the book value of this asset by $36,000. So at the end of year 3, the value of this asset becomes 90,000 minus 36,000, $54,000. Okay. All right. So the reason why the accounting standard setters developed this double declining depreciation method is, again, to be more precise in terms of the extent to which long-term assets lose value. What do I mean by that? For example, if you buy a new car, okay, if you buy a new car, the amount of the loss of the value in year 1 is going to be much greater than the amount of depreciation that you record in year 5, for example. Okay, so in other words, let me scroll down a little bit. Let's say you buy Tesla, okay, Model 3, okay, Model 3 at $40,000. Okay. Generally speaking, at the end of year 1, usually this car will lose value by a lot. Okay. Probably it will lose value by $10,000. Okay. So the value will decrease to $30,000. Okay. However, same Model 3, let's say at the end of year 4, the value would decrease to $20,000. Okay. And then at the end of year 5, one additional year of depreciation, the magnitude, the amount of depreciation expense is going to be lower than this $10,000 depreciation expense that you recorded in year 1. Probably you will lose value by $2,000 in year 5. Okay. So the book value becomes $18,000. Okay. So in the real world, when it comes to long-term assets, the magnitude of the loss of the value tends to be much greater than the magnitude of the loss of the value in later years. Okay, so to estimate the difference in terms of the magnitude, accounting standard setters came up with this double declining method. As you can see here, the magnitude of the depreciation expense is much greater in year 1 than the magnitude in year 2. And then the magnitude of the depreciation in year 2 is, again, much greater than the magnitude of the depreciation expense in year 3. Okay. All right. So let me erase this. All right, let's do year 4 depreciation expense. Okay, year 4 depreciation expense. All right, so the book value decreased to $54,000 as of year 3. We're going to multiply by 2 over service life. Okay, so $54,000 times 2 divided by 5. So the amount of depreciation expense that you want to record is $21,600. That means, okay, the book value of this asset will decrease to $54,000 minus 21,600. That equals to 54,000 minus 21,600. That's $32,400. Now, this is where you have to be a little bit careful, okay? If you take a look at the information here, it says at the end of service life, 5 years, the residual value is expected to be $40,000. In other words, this residual value for $40,000 is the minimum value that you must report for the value of this asset. However, for some reason, the book value, based on our calculation, became $32,000. This is lower than the residual value. Okay, like I said, residual value is the minimum value that you must report for this asset at the end of service life. Okay. However, based on our formula, turns out that I have over depreciated, over depreciated this asset because the book value now is $32,000. Okay. This is lower than the residual value. When this happens, you are going to disregard your depreciation calculation. Even though you follow the formula to calculate the amount of depreciation, when you over depreciate the asset, you are going to completely disregard your calculation. Okay. Then what do we do at this point? We are going to subtract or substitute this book value with the residual value. Okay, so we are going to say that at the end of year 4, the book value will decrease to $40,000, which is the residual value. Okay, then the amount of depreciation expense that you are going to record is going to be the difference between last year's book value and then this year's residual value. Okay, so if I take the difference, $54,000 minus $40,000, we get $14,000. In other words, $14,000 is the amount of depreciation expense that you record in year 4. Okay, all right. So again, when you're using double declining method, it is very likely that you over depreciate your asset, going below the residual value. When that happens, disregard your calculation, substitute the book value with the residual value, and then take the difference between last year's book value and then this year's residual value to estimate the amount of depreciation expense for the year. Okay. So year 4, we've calculated the amount of depreciation expense. What about year 5? Okay, year 5. There's nothing. There's nothing to record for depreciation expense because we've already hit the residual value as of year 4. Okay. All right. So this is how you calculate the amount of depreciation each year. And then the reason why we sometimes encounter this over depreciation issue is because our formula does this double declining method formula does not factor in or consider residual value. There's no residual value component in our formula. However, if you take a look at straight line method, okay, the formula itself has this residual component in it. So you will never encounter the over depreciation issue when it comes to straight line method. Okay. All right. So always be careful when you using the double declining method because it is very likely that in the later years you might encounter this over depreciation issue. Okay. All right. So let's do this mini exercise question before we move on to the next method. A machine that costs $160,000 has an expected service life of 8 years and a residual value of $16,000. Okay. The question is asking you to calculate the amount of depreciation for year 2, second year, using the double declining method. Okay. All right. So for that, we first have to calculate the amount of depreciation in year 1. Okay. So year 1. There you go. So first year, we're going to take the purchase price, $160,000. Okay. The formula says in numerator, we put down 2 over service life. In this case, 8 years. 8 years. So the amount of depreciation expense that you record in year 1 is going to be $160,000 times 2 divided by 8. $40,000. That means we are going to decrease the book value of this asset by $40,000. $160,000 minus $40,000. So the book value decreases to $120,000. All right, year 2. Year two, $120,000 of book value. Multiply this by 2 over service life, 8 years. Okay. All right. So $120,000 times 2 divided by 8. So we get $30,000. Okay. And that's the value that we're looking for. The year two, we depreciate this asset for $30,000. Okay. So choice A is the answer. All right. All right, let's move on to the third method. The third method is called activity-based method. Okay, scroll down. Third method, activity-based method. Activity-based method is kind of similar to straight line method. So let me first provide you with the formula. So you take the purchase price of the asset, subtracted by the residual value. And then in the denominator, we put down the total expected usage. Okay, that's why it's called activity-based method. Let's take a look at here. Okay, so purchase price, we purchased this asset for $250,000. Residual value is $40,000. Okay, and then the total expected usage is 140,000 units. Okay, so 140,000 units. Okay, so what does that mean? Let me do the math here. $250,000 minus $40,000 and then divided by $140,000. Okay, that means for every unit that you use this machine or asset for, we are going to depreciate it by $1.50. Okay. So in plain English, it could be for every hour that you use the machine for, we're going to depreciate it by $1.50. Or for every mile that you drive a truck, you're going to depreciate it by $1.5. Okay, so this is how you calculate the rate of depreciation using the activity-based method. Okay. All right. Now, once you calculate the depreciation rate per unit, I'm going to call this depreciation rate per unit. We're going to multiply by the actual usage. Okay, so you're given this schedule. Year one, we used 20,000 units. Year two, we used it for 32,000 units. Okay, so year one, the depreciation rate is $1.5 per unit. And then the actual usage, we used it for 20,000 units. So that means year one, we are going to depreciate the machine for $30,000. There you go, 1.5 per unit times 20,000 units. Okay, $30,000. And then year two, the depreciation rate is $1.5 per unit. And then the actual usage for year two was 32,000 units. So that means the amount of depreciation expense that you record in year two is going to be 1.5 times 32,000. $48,000. Okay. So like I said, there you go. Like I said, it could be in year one, we used 20,000 hours. So we're going to multiply by 1.5. Year two, if we use miles, we drove 32,000 miles in year two. So we're going to multiply by 1.5 to calculate the amount of depreciation. Okay. So this is called activity-based method. Okay. All right. Oops. I think I missed one method here. Oh, yes. So there's a fourth method. Okay. There's a fourth method, and it's called sum of the years method. Okay, years method. Now, personally, I have never seen a company using this sum of the years method. Okay, so this method, to my perspective, only exists in the CPA exam, okay, or conceptually. But again, I've never seen a single company that uses this method in the real world. Okay, but still, to prepare for the CPA exam, I'm going to discuss how you use this method, sum of the years method. And I can't even explain the formula in a simple English. Okay, so I'm just going to use numbers as is. So this is a $250 asset, residual value, $40,000. We're going to use it for 5 years. Okay, so year one. Okay, the formula is, okay, the formula is in first we take the purchase price. Okay, so purchase price, let me see, purchase price $250,000, and then we're going to subtract it by the residual value, $40,000. Okay, and then we're going to multiply this by some ratio. Okay, so first year, this is a 5-year service life asset. So numerator, we're going to put down 5. Okay. And then in denominator, we are going to do this 5 plus 4 plus 3 plus 2 plus 1. Okay. So this is how you do the ratio for year one. Okay. So that means, okay, that means we have $210,000, multiply this by 5 over 15. Okay. So $210,000 times 5 divided by 15. So the amount of depreciation expense that you record in year one is $70,000. Okay. All right. How about year two? Okay. Year two. There you go. Same approach. Purchase price, $250,000 minus the residual value, $40,000. And then for the ratio, since this is the second year, we're gonna, in numerator, we're gonna decrease by 1, so 4, okay? In denominator, it's 5 plus 4 plus 3 plus 2 plus 1. So by now, hopefully you get the idea in terms of what ratio you're going to multiply it by. Okay. So $210,000 multiply this by, in this case, 4 over 15 in year two. Okay. All right. So 210,000 times 4 divided by 15. So the amount of depreciation expense that you record in year two is $56,000. So by applying this approach, as you can see here, the magnitude of the depreciation expense in earlier years is greater than the magnitude in later years. Let me just do one more year. Okay. Year 3. Okay. So it is $210,000. And as you can probably imagine by now, the ratio is going to be in numerator 3 over 15. Okay. So 210,000 times 3 divided by 15. So the amount of depreciation expense in year 3 is going to be $42,000. Okay. Now, if it is a 3-year service life asset, then in year one, it is going to be 3 over, okay, 3 plus 2 plus 1, okay? And then year two, it is going to be 2 over 3 plus 2 plus 1, okay? All right, so this is the sum of the years methods. Okay, so like I said, this method only exists in the CPA exam, but I've never seen a company in the real world that actually uses this depreciation method. Okay. All right. So these are four different types of depreciation methods. Make sure that you go over this and then be able to calculate the depreciation expense on your own.